Fibonacci retracements are a tool that plots horizontal lines derived from Fibonacci ratios. These lines are often used as significant support and resistance areas. To apply the Fibonacci retracement tool, start by locating a swing low and a swing high on the chart. Then, drag the tool from the swing low up to the swing high. After that, watch for a retracement to occur, ideally toward the 0.382 Fibonacci level, as it's commonly where price reacts or changes direction. If price reaches that level, it could offer a potential buy opportunity. Remember, price can also pivot at other Fibonacci levels, so it's wise to use it along with other confirmation indicators for stronger entries. But before we dive deeper, make sure to like this video and subscribe to the channel for more free, high-quality content like this. We'll continue right after the intro and disclaimer. Breakout patterns occur when price experiences a sharp and decisive move in a single direction. This typically happens following a period of market consolidation. For instance, in this example, the price is seen consolidating, and then it suddenly drops aggressively. This movement is known as a breakout. To capitalize on such moves, traders often rely on certain chart patterns that help anticipate breakouts before they occur. Some of the most well-known breakout patterns are wedges, triangles, and the rectangle pattern. Reversal patterns occur when price shifts direction against the prevailing trend, creating a counter-trend movement. Certain chart patterns can be recognized, which may assist traders in forecasting reversals ahead of time. The most recognized reversal patterns include double tops and bottoms, triple tops and bottoms, head and shoulders, and cup and handle formations. Elliott wave is a theory proposing that markets typically progress in a sequence of 5 waves before reversing direction and creating a new wave cycle in the opposite direction. By analyzing the Elliott wave pattern, traders can estimate where price might be heading by studying the structure on a chart. Each wave can be labeled as 1, 2, 3, 4, 5, followed by a corrective sequence labeled A, B, C. There are a few specific guidelines that validate a correct Elliott wave formation. First, wave 2 should never exceed the length of wave 1 and generally retraces to the 0.618 Fibonacci level. Second, wave 3 must be the longest among waves 1, 3, and 5. Third, wave 4 must stay above the peak of wave 1 and tends to pull back to the 0.382 Fibonacci level. Here's a practical look at the Elliott wave in action. In this chart, price appears to be forming a potential 1, 2, 3 Elliott wave. Based on the theory, since wave 4 often pulls back to the 0.382 Fibonacci level before advancing, this retracement area could present a solid buy opportunity when the price corrects. Fair value gaps appear when a candle creates a noticeable gap, usually caused by an imbalance between buyers and sellers. To locate a fair value gap, begin by identifying a candle with a strong body. Then, mark a rectangle between the wick of the candle before and the wick of the candle after. This highlights the gap area. This zone acts as a potential magnet for price, where the market may return before continuing in its original direction. Candlestick patterns are a method that traders use to study potential price movements by examining particular candle formations. Key candlestick patterns include engulfing patterns, which indicate strong momentum in the direction of the engulfing candle, hammer and shooting star patterns, which suggest price rejection shown by a long wick on one side, and doji patterns, which represent market indecision and signal neutrality in price behavior. Heikin-Ashi is an indicator that completely replaces a traditional candlestick chart with a Heikin-Ashi chart. When applied, it typically shows less market noise compared to standard candlesticks. A green Heikin-Ashi candle indicates that price is trending upward, while a red Heikin-Ashi candle signals a downward trend. The body size of each candle reflects the strength of the trend. The larger the candle, the stronger the momentum. It's important to note that Heikin-Ashi functions purely as an indicator and doesn't show the actual market price. Price moon phases is a concept that applies lunar cycles to market timing. Moon phase traders believe that moon cycles are linked to human emotions and behavior, which may impact market movement. Certain moon phases are thought to align with specific trends. A new moon is generally associated with bullish behavior, while a full moon is often linked to bearish sentiment. Today, this approach is primarily used as a confirmation tool alongside other indicators. Renko replaces the standard candlestick chart with a Renko chart, which differs in how it builds blocks. Unlike traditional candlesticks, which generate a new candle based on time intervals, a Renko chart creates a new block only when price moves by a certain amount. For example, with a 1% price change, a new Renko block appears, meaning each block reflects a 1% shift in price. You can adjust this value through the indicator settings. Traders use Renko charts to minimize market noise and clearly spot trends. A green Renko block signals an uptrend, while a red Renko block indicates a downtrend. Keep in mind that Renko charts are just indicators and do not reflect the actual market price. Harmonic patterns are advanced price structures that follow precise formations based on Fibonacci ratios. Traders utilize these shapes to anticipate future price behavior. For instance, a bullish bat pattern forms when price completes 4 distinct movements that resemble the shape of the letter M. Each turning point is labeled as X, A, B, C, and D, and each point must meet specific criteria. For example, the distance from X to B should range between 0.382 and 0.5, while A to C should fall between 0.382 and 0.886, and similar rules apply to the other legs. These detailed ratios can then be mapped onto a live chart. So, if you spot a price forming 4 legs, you can use the harmonic pattern tool to check whether the structure aligns with any known pattern rules. If it does, a trade setup may be taken accordingly. There are several well-known harmonic patterns, including the butterfly, bat, and crab, each with its own unique Fibonacci values. Support and resistance are important horizontal levels where price has previously reacted and may potentially react again in the future. When the level is below the current price, it's referred to as support, and it's often seen as a zone where buy positions can be considered if price returns to it. On the other hand, when the level is above the current price, it's called resistance, and sell positions may be taken when price moves near that level. And when the level is above the current price, it's known as resistance, where sell positions can be considered if price moves toward it. Dynamic support and resistance, while similar to standard levels, serve as key zones using indicators rather than fixed horizontal lines. Tools like the moving average are used to represent these dynamic levels, adjusting with price movements to act as ongoing areas of support or resistance. Trend lines are important levels that appear diagonally during a trending market. They help indicate the general direction of price. An upward trend line suggests a bullish market, while a downward trend line points to a bearish market. Just like support and resistance, trend lines can also be used to spot potential entry points. For instance, when price pulls back to a trend line, it may offer a favorable chance to take a buy position. Gann angles are a tool that displays multiple lines extending continuously at various angles. These lines can serve as potential key levels and are also useful in analyzing the trend's strength. When price moves within the steep angles, it suggests a strong trend, while movement within shallow angles indicates a weaker trend. To use Gann angles, begin by opening the settings and enabling the lock price to bar ratio option. Then, identify a specific market range and mark its swing high and swing low. After that, draw a straight vertical line at the beginning of that range. Next, select the Trend Angle tool, measure exactly 45 degrees, and then use the Gann fan tool, aligning it with the 45 degrees angle. Momentum indicators are tools designed to evaluate both the direction and strength of a trend. They are most effective when applied in trending market conditions. Some of the most widely used momentum indicators include MACD, an upward crossover suggests a bullish trend, while a downward crossover signals a bearish trend. Moving averages, when price stays above the moving average, it reflects a bullish trend. When price is below, it indicates a bearish trend. Parabolic SAR, a dot below the price indicates a bullish trend, and a dot above the price signals a bearish trend. Supertrend, a green signal represents a bullish trend, whereas a red signal represents a bearish trend. Oscillators are a type of indicator that shows the relative strength of price movement. They are especially useful in choppy or sideways markets. Key oscillators include RSI. When the line enters the oversold zone, it suggests a possible upward reversal. If it moves into the overbought zone, it signals a potential downward reversal. Stochastic, when both lines are in the oversold region, it points to a likely move upward. When in the overbought region, it suggests a possible move downward. Additionally, crossovers between the two lines may help predict future price direction. Divergences happen when an indicator shows a signal that goes against the actual price movement. When this occurs, it often suggests that the current trend might be nearing a reversal. Divergences can appear on various indicators like MACD, stochastic, and RSI. For example, using the MACD, you might notice the price making higher highs, which is typically bullish, but the indicator is forming lower highs, which is bearish. This setup is known as a bearish divergence, signaling that a trend reversal may be near, in this case, potentially providing an opportunity to consider a sell position. Volume indicators are tools that reflect the strength behind price movements by analyzing trading volume. Commonly used volume indicators include price volume. This shows the volume associated with each candle. The longer the bar, the greater the volume. Volume weighted average price, VWAP. It represents the ratio between an asset's price and its total volume, and can be used like a moving average or as a dynamic support and resistance level. Volume profile. This plots volume bars horizontally, and these can act as significant levels for identifying potential entry points. Supply and demand, also known as order blocks, are zones where major price movements have taken place. When price rises sharply from a specific level, that area is identified as a demand zone. Conversely, when price drops significantly from a level, it is labeled as a supply zone. Similar to support and resistance, these zones can act as key levels for spotting potential entry opportunities. Market structure refers to how a trader studies the behavior, condition, and flow of the market. An uptrend structure is identified when price consistently forms higher highs and higher lows, while a downtrend structure is marked by price creating lower highs and lower lows. Break of structure happens when price surpasses the previous price peak during a trend. For instance, if price is forming higher highs and higher lows, then the moment it breaks above the previous high, that move is referred to as a break of structure. Change of character occurs when price breaks the previous market structure within a trend, often indicating a possible trend reversal. For example, if price has been forming higher highs and higher lows, but then breaks below a previous low and starts forming lower lows, this shift is known as a change of character. So, did I miss any strategies? Let me know in the comments below. Thank you for watching. If you found this helpful or enjoyable, I'd really appreciate it if you could like the video and subscribe to the channel. It only takes a moment, but it truly means a lot. Feel free to check out my other videos as well. Thanks again for watching, and I'll see you in the next one.